welcome to Tesla Live. I believe this is episode 254. Episode 254. Let's change that name over there. Um, Markets are up today. Happy Monday, everybody. Happy Monday. Tesla is down 0.7% at $407.73 as of right now. I believe that is the low of the day. So Tesla's testing the low of the day. Let's see if we do. In the 5 days, Tesla is down 3%. In the last month, Tesla is flat around $400 per share. The peak was on December 17, so mid-December. So it's right around, um, people realize, I think, when interest rates are going to continue to stay high for a little bit, that's when I think the Tesla stock price maybe peaked a little bit. And and that's when I increased my short position on the company. Um, Thank you for letting me know that audio is good on X and YouTube. All right, let's get going. Let's see. Overall markets are up about 1%. Nasdaq is leading with 1.4% increase. S&P 500 up 0.9%. Nvidia is up about 5%. In the last week, Nvidia is up more than 10%. Jensen is going to speak at the CES 2025. I think that's today, keynote speech. And I think NVIDIA shareholders are expecting some sort of a announcement. The stock ran up just like Tesla stock runs up before Tesla events. I think this is a short-term phenomenon. I looked into Microsoft's announcement of about $80 billion in the fiscal year 2025. And I don't think that's out of consensus anyway. I think the Microsoft announcement is pretty much as expected by the market, and this is the plan for the next 2 quarters because the fiscal 2025 is already midway for Microsoft as opposed to the 2025 calendar year. So Apple is down 4%, Tesla is down 5% during the last week period, Nvidia up 10 more than 10%. Nvidia is holding up to markets and the semiconductors, let's see, especially semiconductor equipment and materials are up about 7% in the last week. Computer hardware, including Dell, HP, and let's see, Western Digital are also up substantially in the last week period. Uber is up 9% in the last week. That's after the stock sold off quite a bit following, the understanding that Tesla maybe was going to introduce robo-taxis sooner than people expect. And I think Tesla bulls and market in general believe that Uber will be hit pretty hard because neither Waymo nor Tesla will need Uber to build their own platforms. So it's $140 billion company. Uber is. I think the transition will be slower than people think. So I wouldn't short Uber here, but it is the company I'm watching just because it has hands on a lot of different things. So Uber, let's see. So one the research I've been doing in this morning and last few days is to kind of understand the employment market in a more granular basis. Uber is a very important company. Let's see, Uber number of drivers today are in the U.S. Um, Give me 1 second. Uber number of drivers in the U.S. are about 7 million worldwide. Uber has employs 7 million drivers, more than 7 million drivers and couriers worldwide, which is an incredible statistic when you think about it. I mean, how many companies have that level of, you know, number of people touching? Like Amazon in the US, let's see, I think is about a million just in the US. Now, we compare US versus worldwide here, but let's see. Amazon employs about 1 million people in the US, including fulfillment centers, Whole Foods, etc. And Walmart in the US employs about 1.6, 1.7 million people. Um, and then globally, there's also a number of people too, but we're just focused on US. I'm just focused on US employment market right now. So when you think about that and how many people Uber employs in the US, 1.5 million drivers, accounting for 28% of Uber's global driver base. But I think that's as of beginning of 2024. And driving for Uber has become more acceptable in the society, as opposed to looked down upon in previous years. And I would expect that to continue to increase. And as Uber grows its Uber Eats business and other segments, Uber's importance in the American employment market will continue to increase. And it really changes the dynamic of when people get laid off, that they download the app, maybe start driving for Uber. So it kind of acts like a in the economy, kind of acts like a unemployment benefits sort of thing. So you can collect unemployment benefits while also driving for Uber. Um, when there are, we also saw the impact of this last year in strikes, the UAW strikes. Some people were making more money driving for Uber than um, collecting from the UAW union. So so very interesting. So these are the reasons why I think when people look at, oh, this recession, you know, the interest rates curve compares to 1995, or the inflation compares to the 70s, etc. Like people always look for analogies, but I think that's a futile effort because everything, a lot of things change um, cycle to cycle. So you have to do a first principles analysis, otherwise you're going to get caught and making reaching the wrong conclusions. So this represents a significant increase from 2019 when Uber had about 1 million US drivers. So 1 million 2019 to 1.5 million at the beginning of 2024. And I would expect that to reach about 2 million sometime in 2025. So the thing is like um, 2019, especially, you couldn't drive for Uber back in COVID, obviously. There wasn't a lot of people traveling. So, ground wise. So, um, or people bought their cars and everything. So, but as the unemployment rate continued to increase over the last 12 to 18 months, I think Uber is having an easier time recruiting drivers. So I suspect they have about 2 million drivers today and more than 8 million drivers and couriers worldwide. Amazing, really stunning statistic, I think. And then so other top employers in the US are Walmart, close to 2 million US employees, and that's excluding their suppliers. So Walmart, 1.7 million, including Walmart supercenters, Sam's Club, and distribution centers. If you include their suppliers, you're getting to about, 2.5 to 3 million people in the US. Amazon has about a million in the US. If you include their suppliers, you're looking at 1.5 to 2 million people. And obviously, there's going to be some overlap among these suppliers, but the top companies and employers are Walmart, Amazon, McDonald's, Kroger, Target, UPS, Home Depot, Starbucks, Berkshire Hathaway with all their companies, FedEx, Lowe's, etc. So if you group them, you're looking at Walmart, Amazon, Target, Kroger. Okay, so that's one group right there. Um, you could even add McDonald's in there, I'm guessing. Maybe. Then you have UPS and FedEx transportation. Then you have Home Depot and Lowe's. And so you can look at these if you want to understand the employment market. You can look at these group by group and see how those are trending. Yeah, really interesting. So this is what one thing I'm working on from macro perspective. I'm going to continue to work on this and kind of try to understand the employment market a little bit better. see which way the employment market is trending here. All right. Any questions, comments? Please request to speak. Otherwise, I'm going to read the T. Rowe Price warning on Treasury yields. T. Rowe Price warning on Treasury yields. In the meantime, Tesla stock is down 0.4% at around $409 per share, testing the lows of the day. Nvidia stock is up another 5% today at $151 per share. I think it's close to 52-week highs. So it's close to all-time highs for Nvidia. Jensen is supposed to speak soon. Carvana's stock was up quite a bit in the morning, then down all the way to almost zero. Now down, up a little bit again. So it's a very, very volatile stock. Axon down about 8% in the morning, recovered a little bit, down 6% today. Rivian down 2%. Um, Ford is trending around $10 per share. GM stock is up 4% today. Um, I think that's another overvalued company, but it's hard to short a company with 5 times PE ratio. Um, Interesting news on the Tesla front. BYD, a major competitor in China, at the top of our screens, BYD invents a new suspension system that allows a car to jump over potholes without a driver. So we're talking about 6-7 meter pothole like jumps, which is pretty impressive. Um, this is a suspension system that they talked about earlier, and BYD is a BYD is a top 5, if not top 4, automaker in the world now, aside from Toyota, Volkswagen, and I think the other one is the Renault Nissan partnership. But so they're and GM, they're kind of pretty. They become a global player now, and that's before they build their factories around the world. I heard that they're looking to build a factory in Turkey. Um, so obviously, when that happened, and I kind of had a conversation about BYD offerings in Turkey and Tesla offerings, and BYDs are priced like half the price versus Teslas in Turkey. So I think um, to the extent that FSD takes a few more years to mature, we're looking at a very challenging environment for Tesla outside the US. I think Tesla automotive sales, even though rising in China, Tesla's losing market share to BYD and other Chinese companies. And I don't see that changing anytime soon. I don't see that trend reversing anytime soon. The US is doing somewhat okay market share wise because of Cybertruck sales, which are now challenged a little bit more. Troy put out a really important tweet that is that I think is ignored a little bit. Troy is one of my favorite accounts. Just a lot of data. I like accounts that tweet data as opposed to opinion. Um, and so let me pin at the top of your screens Troy's tweet. Okay. So Troy says, VIN data. This is really important. Okay. So as if you remember, Q3 earnings, Q3 margins. Um, I highly recommend people read the entire tweet and the thread that is now pinned at the top of your screens. Okay. Please read the entire tweet and share it. Troy gets a lot of slack from accounts that are popular, but really more noise than signal because of envy. I think Troy is envied very much by some of the influencers in the community, and because of the respect that he gets from people that are more experienced and data oriented. So he puts in a lot of work, and his accuracy is unmatched over the years. I mean, he's been around for more than 10 years. I think there's something to be said about being around for a long time, going through the ups and downs with the company. So, and having a proven track record. So, Troy says So just a background, if you remember, Q3 margins had surprised to the upside a little bit, and then the management spent 90% of the call, earnings call, basically filibustering analyst questions. I mean, it was a sight to be seen. So highly recommend if you missed it, highly recommend listening to Q3 call. We're gonna have a Q3 earnings call watch party before the Q4 earnings call. Um, but I'm going to have it on Tesla Live on the YouTube channel. So, and Troy explains why the Cybertruck was profitable in Q3, and why it's a temporary measure. Okay, I mean, if he's correct in this analysis, this does not look good for Cybertruck program at all, and I'll explain why. In short, if what Troy's saying at the top of your screens is correct, then the Cybertruck is more similar to Rivian than Tesla's sexy vehicles programs, because of the difference between gross margin and contribution margin and operating margin type of thing. So Tesla bulls should wish that Troy's incorrect, and there's a possibility that he might be incorrect on this too, and I'll explain why that is as well. Before that, any questions, comments, please reply to the space or leave in the YouTube live chat. So Troy says, and I'm going to put this on. Let me put this on the um, on the YouTube screen as well. Okay, here it is. VIN data. Man, dude, this is not showing. Oh, there it is. Okay, here it is. VIN data, vehicle identification numbers, show that Cybertruck performance version. So performance would be Cyber Beast. Okay. Cyber Beast sales returned to normal in Q4 2024. Tesla pulled a clever trick in Q3 2024 to make the Cybertruck profitable for one quarter by holding back performance version deliveries from earlier quarters and delivering them all at once. This pushed performance version deliveries to an impressive 41.5% of all Cybertruck deliveries in Q3. Okay, so I'm going to read that again. Tesla pulled a clever trick in Q3 2024 to make the Cybertruck profitable for one quarter by holding back performance versions, which is Cyber Beast, from earlier quarters and delivering them all at once. This pushed performance version deliveries to an impressive 41.5% of all Cybertruck deliveries in Q3. Q3 2024 was Tesla's last shot at profitability before introducing the regular versions in Q4, which sell for $20,000 or less. Here's a breakdown of the versions sold so far. And he shows, I'm going to pull up the graph on YouTube so you can see it. You can see here 2024 Q1, Q2, Q3, Q4, Cybertruck performance, which is Cyber Beast. Okay. And the Model SX performance, which are the blue columns. So you can see that Model S and X performance versions are not increasing. They're pretty stable at around 23%. But then there's a big bump in the 2024 Q3 numbers, doubled from Q2 to Q3 Cyber Beast deliveries. And it's down back to a normalized level, a normal level in Q4. Okay, so that's going to, is it going to be a headwind to gross margins in Q4 that I hadn't been mentioned anywhere else except for Troy? So, to the extent that you see anybody giving a hard time to Troy, I encourage people to defend Troy. I think accounts should be defended. Um, Accounts like Troy's, where they're data oriented, clearly add value to the conversation. They've been around for a long time. That I think people should not sit on the sidelines and defend these accounts. Um, so the next one he says is so there's a bunch of replies. So I'll come up to on the YouTube channel so you can see it as well. Troy says no, the Cybertruck won't be profitable in Q4 2024. which is very rare for Troy to say stuff like this. Like it's a very definitive statement. Cybertruck will not be profitable in Q4 2024. It was barely profitable in Q3 thanks to the 41.5% performance version sales and the $20,000 higher price tag for the Foundation series. Some people argue that while the Foundation series was priced $20,000, you got $13,400 worth of extras, including FSD. That's true, but those extras, especially FSD, don't cost Tesla as much in terms of COGS. So while the price is $20,000 lower in Q4, Tesla's cost is only $3,700 lower, which what he means is Cyber Beast has a dramatically, or the Foundation series deliveries have dramatically higher gross margins than the regular version. Okay. Now, in another reply, he says, this is also at the in front of your screens on YouTube. Troy says, the $7,500 tax credit for the long-range all-wheel drive version won't help gross margins because the buyer I don't think that I agree with that, but he says, currently, the $7,500 federal tax credit is an instant point-of-sale discount, meaning the buyer pays Tesla, etc. As a result, Tesla still gets $80,000, but it costs them around $100,000 to produce. So Troy is assuming that the Cybertruck production cost it remains at $100,000 per unit in Q4 versus Q3, and I think this is not a good assumption. And I think the production cost per unit will probably decline more than what he said in the earlier tweet, $3,700 difference between Cyber Beast and the regular version because of the high utilization of production lines. So I don't think this situation is as bad as Troy indicates, or kind of sounds like. But I think this is still very important to note for Q4 margin estimation. So if you've seen other people talking about Q4 margins, like for example, James Cat, another great account, close to follow, he hadn't mentioned this. And despite that, he had already concluded that Q4 margins will be worse than Q3. Okay. ACDC, what do you think about this?
Yeah, I read some of those tweets. I think Troy's spot on. I personally never thought right from the launch date that the Cybertruck would be, I mean, as awe-inspiring and as great as the Cybertruck release event was, I just never thought that this is like the Model Y moment by any means, or it's going to be really a hit. I've tried to like it multiple times. You know, I test drove it last a couple months ago when they finally dropped it to the $80,000 price point, and they were giving a FSD transfer, and I just on a practical basis, I just couldn't get to it. You know, so I think the wow factor is there, and we may see a little bit of the boost from the $7,500 credit added to it. But I just don't think this is a mainstream product that'll really catch on.
Yeah. I think it's a great product. I've driven it and I studied in detail. I think it's a great product. I think where they kind of missed the mark is the 4680 batteries were supposed to be better, way better by now, and higher volume production by now, lower cost, higher energy density, lower weight. So that translated to Cybertruck weight being way above what I originally thought based on comments in the 2019 unveil. It was supposed to be the same weight as F-150, and it is not. It's about 1,000 pounds heavier. So and they haven't really improved on that in the last 2 years. So and now the guy who's Drew Berlino, who headed the 4680 program, is gone. So that also doesn't bode well for future expectations for the 4680 program or the Cybertruck. So if Troy is right, that the production cost is closer to $100,000 and Tesla's having to lower prices below the incremental production costs per unit, then it's possible that Tesla will have to end the Cybertruck program. Like, you don't want to, like, just like Rivian basically ended the R1T program. They didn't end the program, but they're not selling any. They just switched to R1S. Maybe Tesla will do a cyber SUV instead of the Cybertruck. Who knows? Maybe that's what's necessary here. Do you think Tesla should do that, cyber SUV as opposed to Cybertruck? Maybe that's what they'll announce in Q1.
I think that would be a much better product for the mainstream. I think there's a lot of stuff. I mean, it's a great product, and I know when you're saying that I love the product. I mean, I love it too, but it's just a very niche product. It's not a mainstream product that you're going to get a lot of sales out of.
I mean, the problem with the cyber SUV idea is that your production cost will be higher than the Cybertruck, and your range will be lower than the Cybertruck. And the Cybertruck range is already low. And you're competing against gasoline SUVs, like gasoline SUVs that are half the price. And also on the R1S is struggling, competing against the Kia, I think EV5 or EV7, the Kia version of their electric SUV. So it's go ahead.
Sorry, why do you say that the range would be lower on the SUV? I mean, the SUV will not have to have stainless steel body. That would save on the weight and cost.
Yeah, Kia EV9 is only because there's more material. I mean, I don't know, so that wouldn't be a cyber SUV if it doesn't have the stainless steel body, right? So that would be a different vehicle altogether. I mean, if Tesla were to introduce some sort of SUV, I think we'd start hearing rumors about it. I don't think they were going to come out all of a sudden and start producing a cyber SUV. These things kind of, like, we heard about the Model Y years ahead of time, Model 3 years ahead of time, Cybertruck years, the Semi, all of these vehicles. Go ahead, ACDC.
Do you think, apart from the Juniper refresh, Tesla's going to introduce any new model this year?
Yeah, I think they talked about 3 more affordable models. So I'm guessing one of them is the $80,000 Cybertruck, one of them is the Model Y refresh, and then there's supposed to be like a smaller Model Y that Troy also posted about. Did you see that? Got a lot of views. Did you see that tweet?
Was that yesterday?
No, here, I'll pin it at the top. There's a supposed leak of the vehicle. So this is the Yan Chang, and I'll show this on YouTube as well. Yan Chang account shows a picture, spy photo of a facelifted Model Y with the least noticeable Photoshop traces he's ever seen, it says. And Troy posted and said, I hope the Model Y Juniper does not look like this because maintaining the same level of sales will be difficult if it does. And his tweet got 200,000, close to 200,000 views. So I think there might be a smaller vehicle that Tesla produces. But I guess where I disagree with Tesla Bulls on this one is it's going to eat into the share of the Model Y and Model 3 sales. Like, I think Model 3 and Model Y sales would be significantly cannibalized if Tesla introduces a lower price, a smaller, kind of like a BMW X3 type of level. Because Model Y is more of a like X4, X5, interior space wise, functionality wise. And I'm guessing Tesla is thinking more about like X2, X3 type of smaller vehicle, somewhere between Model 3 and Model Y. And it just doesn't solve the, like, people think affordability is the problem, but I don't think it is. Like, Tesla introduced, if affordability was a problem, okay, the 0% financing is a massive deal. Like, I don't think people realize how massive of a deal the 0% financing Tesla had throughout Q4 is. They had it at the beginning of the quarter. They had it throughout the quarter, except for the last 2 weeks. Okay. And the reason is because the new auto interest rates, average interest rates are about 9% today. Okay. And if you're offering 0%, now let's assume you're only offering to buyers with excellent or great credit. So anybody above 700. All right. If anybody above 700 gets it, and majority of the US has above 700, and I would estimate that most of Tesla buyers in the US have above 700 credit. So I would guess most buyers qualified for that 0% interest rate offer, APR offer. Okay. If you do the math and you don't have to go through your calculator, just ask ChatGPT. What is the estimated payment that Tesla has to make to the lender to finance, to basically incentivize 0% APR? So Tesla makes a one-time payment at the time of the vehicle sale for the difference on the interest cost. And you have to ask it as, present value of it, right? That comes to about $8,000 per Model Y sale. That is a massive cost to Tesla, you know. And who knows? Maybe there's a bit of a discount because Tesla's buying in bulk or whatever. I don't know. Or maybe there's. I mean, I don't think there's I don't think the lender can go back to Tesla to kind of make up for any unforeseen losses on the resale values or whatever. So I think Tesla did that early on in its history, but I don't think they do that anymore. Especially not at this volume. I don't think Elon would do it. Would take on that risk. So we're talking about an $8,000 payment from Tesla to the lender for the 0% APR. If you think about the APR ASP of Teslas today, you're somewhere between 40 to 45,000. That's almost a 20% incentive. That is a massive. I mean, what am I missing here? Like, is that not the case? Is just the 0% APR alone? Is that a 20% incentive ACDC? Am I missing something?
No, that's coming right off the bottom line.
Yeah. And on top of that, you have 3 months of FSD. You have price cuts in the new inventory page, which are up to $4,000 in Q4. You have low utilization rate for production lines around the world. You have higher wages in recent years for your employees. Um, um, I mean, the only thing that's kind of partially offsetting that is lithium prices came down quite a bit. And Tesla realized a lot of that benefit in Q3. There's going to be some more of that in Q4, but that's about it. And then partial offset again from Z credit sales as well, which the U.S. government is going to try to get California to stop doing that. But that's TBD. What other incentives were there? There were a couple of other major ones. Let me kind of just look through this list that Sawyer posted.
3
Kind of
months of free
midway through.
supercharging.
Yeah, you have free lifetime supercharging as well for Cybertruck sales.
Model S also.
Model S, and also Model X, I think, in Q4, but I think Model X may be discontinued. So that's another. We're talking like a $10,000 to $20,000 benefit for free lifetime supercharging. And despite that, sales of Model S X and Cybertruck are super low, and X also qualifies for the $75 credit as well. So despite all that, you have your sales massively missing estimates.
Wasn't there also an added
Here you
benefit?
go. Here you go. Here's the list at the top of our screens, and I'll put this on YouTube as well. 3 months of FSD and supercharging. We're talking about several $100s of benefit there, obviously. Up to $2,000 off any new vehicle purchase with the referral or link, which used to be about $1,000, I think. So they upped it as well. Free FSD transfer for SX3Y and Cybertruck. I mean, that is a massive incentive. That's also several $1,000s. 0% APR for 3 and Y, which I estimated at somewhere between $6,000 to $8,000 depending on the trim and the loan value, which I'm guessing most sales are financed, and most buyers qualify with a 700 plus credit score. Model X all-wheel drive, one paid option included with purchase of FSD. Model 3 Performance free paint option with the personal FSD. These are also like several hundreds of dollars. $1,000 discount for members of military. And this, I mean, I think that's a small number of people who qualify for that anyway. And then inventory discounts of up to $4,000 for select vehicles. So I think the level of like total incentives here, especially if you consider the free lifetime supercharging for these vehicles, some of these vehicles, you're looking at somewhere between $10,000 to $15,000 of incentives. That is unmatched, I think, across the industry or across the world, really. You're looking at a 20-30% discounts. And the two primary reasons for this is one, high interest rates, two, the hybrid sales around the world outgrowing pure EV sales by like double the pace. So ACDC and then Stephen.
Yeah, and another benefit that's not mentioned there was the benefit for leasing and giving you the option to buy back your lease, because some of the lease payments were insanely low, and people were still and people had the option to buy them back and still weren't taking the leases also. The second thing I would like to say is that I don't know if you saw the tweet that Troy put out today. It was right around 10 a.m. or so where he broke down the numbers by US, and then um, and the quarterly sales and everything. I literally think that that's what moved the market on Tesla stock, because Tesla was actually up until then, and then it dipped into the red. I mean, I think there's enough analysts who may be following Troy's numbers and respect those numbers. And when people are looking at it, and then they also look at the fact that overall in the US, the EV industry was up. Some of the traditional makers actually had their best and record years of EV sales. So no matter what, these people are eating into Tesla's shares, and they can probably continue to do so by subsidizing the cost of it with their ICE vehicles.
So he tweeted a bunch of times. So which tweet are you referring to from today?
It was right around 10 a.m., 10:06 a.m. or so.
What was the tweet about? Can you repeat that, please?
Yeah, I'll pull it up. Well, you can go to Steven in the meantime.
Okay, Steven.
Hey, thanks, sir. Mine's kind of the same realm as Cybertruck demand. I'm just wondering what you think in terms of the appearance of the truck. Are they going to change it in the near future? If they don't, do they actually expect that truck to be a contender in the EV pickup market? I know you like the truck, Imam, but all the data indicates that the public doesn't like it. So do you think they're going to ever change it? Do you think this is going to be the flagship model? No questions asked. That's it.
I mean, Elon has said in the past, if Cybertruck doesn't work, then they can introduce a more traditional truck. But yeah, I don't know. I don't have an answer for that. But it's not going to happen in the near future. I don't think that's a major undertaking.
Thanks.
ACDC, do you have the tweet you were talking about?
Yes, I do. So I just reposted it to the thread here. It's where he mentions Tesla sold 168,956 cars in the US in Q4 2024, just 7,568 more than Q3 and 511 more than Q2, despite running many promotions and offering discounts and stuff. And he breaks it down really. And when you look at it, and I think it was Yoda who asked him a question about, can you compare this to 23 numbers and stuff? And either which way you look at it, the numbers just did not look good.
Yeah. I pinned it at the top of our screens as well. And I'll show this on YouTube as well. So Troy says Tesla sold, I actually missed this one. Thank you. Tesla sold 169,000 cars in the US in Q4, just $7,600 more than Q3 and 511 more than Q2, despite running many promotions and offering discounts. Yeah, this is amazing. For some reason, Tesla chose to clear out all Model 3 and Model Y inventory in the US at the end of Q4. They finished the quarter with just 742 Model 3 Y left. However, supply wasn't an issue because they adjusted production to match demand. Global inventory was 77,738 units. U.S. sales for the year dropped from 657,000 in 2023 to 623,000 in 2024. And this is, by the way, without BYD being allowed to compete in the US. Okay. A decline of 5%. It's unclear how much of the demand issues in the US were due to brand image challenges caused by political controversy. Okay. And also, one thing I would add here is the Cybertruck was added to the lineup this year versus last year. I mean, that's a major one as well that he didn't mention here. So we have 20% of incentive levels this year, lowest prices ever, highest incentives ever, a new product in the lineup in one of the major categories in the US, the Cybertruck. And despite that, the deliveries are lower by 5% in the US. And despite BYD not being able to sell in the US. And also, you have your $75 tax credit, which are supposed to go away next year. And this is again for the whole year. And he also makes comparisons for the Q4. But I think what happened was in the second half of December, after mortgage rates and auto loan rates reversed back up because they were declining before that. I think the demand kind of fell off a cliff. I think the economy fell off a cliff in the second half of December that people don't realize yet. It's because it's not in any other data. Like this week is very heavy on economic data, and but it's going to be all for December, for the whole month. So you're not going to see the big drops in consumer spending, I think, for these capital goods and houses. And housing is also challenged because it's seasonally low anyway. So people will assign some of the weakness to seasonality. But under the surface, I think there's some really strong headwinds in the economy in recent weeks. So we'll see. We'll see, Matteo. I mean, we're already seeing a little bit of that. I'll pin at the top of our screens, and also show it on YouTube. There is a problem going on with the GDP now estimate. The estimate was revised very significantly from 3.4%. This is at the top of our screens and also on YouTube. The GDP now estimate, Atlanta Fed G now estimate, was revised from 3.4% in the second week of December to now 2.3% for Q4. Okay, so in just 2 weeks, the estimate was revised very significantly from 3.4 to 2.3. And usually revisions continue. Like when there's a trend in revisions, it continues for a little bit as more data comes in. So, the pressure on the economy has never been stronger in the last decade or so. I think this is as high pressure as pre global recession. So 2006, 2007 levels in economic activity. And there's other headwinds that I haven't mentioned yet. But so that's why one of the reasons why I'm short on a lot of stocks, including Tesla. And then if you look at from an employment market perspective, if you look at the companies that are doing better in the stock market, they're seeing their sales grow, profits grow, stock prices grow. These are not, like Nvidia is not a major employer in the United States. So the vast majority of the companies, like Russell 2000, the small cap stocks, that index has been flat for the last 4 years. And they're facing tremendous refinancing debt risk in the coming years because they've kind of loaded up on debt on their balance sheets with unprofitable, because these are unprofitable companies, low free cash flow, if not negative free cash flow, lots of debt on their balance sheet at 0% interest rates, like very low interest rates. And it's not like they all have to refi their balance sheets when the Fed hikes. These companies have all the debt have several years out maturity. So the rollout of the debt happens over several years. And if the rates stay high here, they're going to go from a few percent interest rate to several percent interest rates, and sometimes double-digit interest rates. So we haven't yet seen the deterioration in their balance sheets and income statements and free cash flow because of the high interest rates. So that's also yet to come in the coming years. So people are thinking about, oh, let's switch to Russell 2000, like Tom Lee said in July. Sell the Max 7, switch to Russell 2000. And the Russell 2000 has continued to underperform in the last 6 months. And I don't expect that to change until after a recession, if ever. But we'll see. ACDC?
Yeah, I completely agree. The cost of financing to those smaller companies is much higher than some of these mega caps that everybody's looking at right now. Also wanted to just get your take. I don't know if you saw this article from Car Dealership Guy. He mentioned the Cox Automotive forecast of 2025 being the strongest year in half a decade. And they think it's going to be 16.3 million total units, up 3% from 2024, and also have a higher forecast for the used car market. That was surprising to me.
So let me pull up his account and see the tweet real quick. So this is the Car Dealership Guy.
I can post it right here.
Yeah, please do. Yeah, let me see what you posted here. When you say you posted here, you're talking about just replying to the space, right? Okay, let me see. Okay, I'll pin it at the top, and I'll show this on YouTube. Man, we're covering a lot. I mean, I kind of said I would limit this to 1 hour, but the strongest year for car sales in a half decade, Cox Automotive thinks so. They're forecasting the strongest new car sales in 5 years, 16.3 million units, up 3% from 2024. And used car sales are expected to hit 20 million, the highest level since 2021. So what's driving the optimism? Declining loan rates and bigger automotive incentives are making vehicles slightly more affordable. And there's talk of interest rates dropping another full point by spring. That's not going to happen. Let me see. So this is January 3rd. He posted this. But where's the article? Where's the Cox Automotive article? Does he have that link? He just links to his own website. Okay, let's just read this. Adding even more fuel to the market. On top of that, consumers are also feeling good about the buying process. 72% of new car buyers rated their dealership experience better than expected, but not everything is smooth sailing. EV tax rollbacks could slow adoption. Tariffs, tough immigration policies might shake things up, etc. All signs point to a robust year for sales, but a few curveballs could still test the market's momentum. Yeah, I don't think this sounds more like an opinion piece than anything else. Let me see what Cox Automotive said in 2020. Let me just Google this and see if I can find it. I think he's a good account, but not one I follow closely. Let's see. Cox Automotive Aaron Keating predicts a robust 2025. Cox Automotive Industry Insights and Forecast 2025 call was 3 weeks ago. Again, this is before. Yeah, exactly. This is before the interest rates turn back up, right? So this doesn't disprove what I just talked about earlier in the call. Cox Automotive forecast, December 17. They say this is the date. So I don't know why he's bringing it up now. Driven by a strong Q4 and post-election boost, U.S. auto sales beat expectation in 2024, expected to finish about 15.8 million, best result since 2019. Okay, updated January 6th. New vehicle sales in 2024 finished near 16 million, according to estimates from Cox Automotive's Keller Blue Book, an increase of just over 2% from 2023, and the best year for volume since the pandemic. The new vehicle sales ended the year strong, just about the Cox Automotive new vehicle sales forecast. Nearly every automaker posted higher sales year over year 2024, with Stellantis and Tesla notable exceptions. GM was the top-selling automaker in 2024, while Honda and Mazda delivered strong growth. Retail sales were particularly strong at year-end. So, yeah, I mean, I guess we'll see. I see this as a dated forecast. I think there was a regime change, but who knows? Maybe they're right. I guess we'll find out. Forecast 2025. As the auto market heads into 2025, Cox on the Economic and Industry Insights team anticipates the new vehicle market to grow approximately 3%. Overall, the team expects 2025 to be another positive year for car buying. Yeah, I don't think so. I disagree. I disagree with that view. What do you think?
I think they're basing it largely on interest rates, and interest rates on the short end have not quite climbed as the 10-year, but they've still stabilized and been flat. And the only way we see further interest rate cuts is if there's significant weakness in the economy. And in that case, it kind of negates the whole low interest rates versus demand for new cars itself. So yeah, I don't agree with it. I was just surprised to see that Cox Automotive, which is, a reputable contributor to the automotive industry, was making such a forecast.
Yeah, I agree. They are reputable. You're right. They do a lot of data research. But I wouldn't look to them to make a off consensus call, to be honest with you. All right. What else? Does anyone know when Jensen is supposed to speak for the CES 2025? I couldn't find it. On Monday, NVIDIA CEO plans to deliver a keynote address at 9:30 p.m. Eastern. The event can be viewed on NVIDIA's website. The speech comes in the wake of NVIDIA's bullish move Friday above its 50-day line. Okay. So tonight he's going to speak, I guess, 6:30 West Coast time, 9:30 Eastern. Man, we live in amazing times. Any other questions, comments? Carvana is very volatile. Up 5% today, down 26% in the last month. Axon, AXON, seems to be finally breaking below its 600 per share support line. And it could be a quick trip to 400 here, but we'll see. We'll see about that. Palantir down quite a bit today. Any news on Palantir that you might have noticed? Down 5% today, Palantir. That's in line with their pricing volatility, usual volatility. I haven't really seen any news on that front. Tesla down 1.2%. Still, I think, overvalued by about 100 to 100%, 100 to 200%, let's say. And then I'm adding to my shorts as much as I can across. I think the macroeconomic call is the big one here. I think we are at the brink of a recession if it hasn't started already. So I'm going to be watching these GDP. I mean, we're going to get a lot of economic data. So let's see what we're going to get today. Today, we got the PMI services final for December, came in at 56.8. Factory orders for November dropped 0.4%. Tomorrow, we have ISM services for December, JOLTS, which is a close to watched metric. Job openings number is for November. I think the November data is just Like, you're not going to see any sort of effect from election results until December, January. So you can, I discard anything before December at this point. Wednesday, we have the NBA mortgage applications index, ADP, employment change, and FOMC minutes. And then Thursday, we have initial claims and continuing claims. And Friday, we have the non-farm payrolls, average hourly earnings, December, unemployment rate, average work week, and as well as consumer sentiment from the University of Michigan for January. So that's the Friday, we're going to get the first read for the January data, Michigan consumer sentiment. We have a request to speak. Let me just check this person real quick. Let's bring him up. Okay, go ahead.
Hi. So I'm new to your space, but I've listened to you in some other forums, and I'm very intrigued or impressed rather by your. I mean, I haven't been following your space. I apologize, but the most recent ones that I heard you mention have all hit the target, right? Carvana, um, Axon, to be very specific, and I wish I had shorted it. I mean, those were over 600, right? Like I think it was 630 or 640 when I first heard you mention it, and everyone was a lot of the people who trusted in that were very skeptical, but it kept saying it would go down, and when I looked at it today, I was like, oh wow. So, and I just heard you say that it's going down to 400. May I ask what made you decide to short it?
Yeah, thank you. So yeah, exactly. I think most of my shorts have already played out pretty well. Axon, AXON, Carvana, and MicroStrategy, um, and also housing sector. I had a pretty big short there too. They came down like 40, 50%, some of them. And
Yeah. You
but I
you
think
still holding
it,
the MSTR short? Sorry, I
no,
forgot to ask
I
that.
closed MSTR. I closed MSTR a few days ago, and it actually bounced. So I'm actually looking to open that again. But
At what
um,
level, do you know?
no, I don't know, and I'll
Okay.
I'll tweet it out if I ever do so.
Hmm.
Um, the challenging part right now with MicroStrategy is Bitcoin is still pretty high. When I shorted MicroStrategy, it was trading at 3 times its book value, 3 times of its Bitcoin holdings. Today, I think it's less than 2 times because they continue to buy Bitcoin. Bitcoin prices have increased, and MicroStrategy stock has declined. So I probably wouldn't open it unless if it goes up back up like all-time highs or something. Um, and then the hype really has come down in MicroStrategy stock. So I look for a lot of different things, but primarily these are all valuation shorts. It's always surprising when people say you shouldn't short based on valuation. I'm like, what the hell are you going to short based on that? You know, like even when you look at the Carvana shorts, that's the reason you have to stay on mute when you're not talking. Thank you. Um, Even when you look at the Carvana research report by Hindenburg, they start out with one or two sentences on their valuation, and then they write like dozens of pages on the other stuff. But the other stuff is so speculative. I understand they talked about their interviews and stuff, but a lot of the interviews are disgruntled ex-employees. Like, of course, an disgruntled ex-employee is going to talk negatively about their company. That's not surprising. And we don't have their names. There's not much many specifics. So I'm not really increasing my short position on Carvana based on Hindenburg, but I do think the stock is drastically overvalued. So some of these stocks that you mentioned, Axon, Carvana, they're still overvalued. So I would say those are still my best short ideas for the coming months and quarters. Um, MicroStrategy, I'm on hold for that because I think the fundamental value of the company has increased to the I don't really have a view on Bitcoin. I stay away from it. I do think that it's going to come down drastically in a recession scenario, but I'm not. My MicroStrategy short is not a short on Bitcoin. My MicroStrategy short is more a short of the hype around the company and some of the statements that the CEO makes. And I think a lot of that is adjusted already. I already made like 40, 50% on that short. So um, Axon, these another thing I look at is CEOs trading records. Like the CEO dumped, I think tens of millions, if not hundreds of millions of dollars at prices lower than half the current stock price. So that tells me, the guy who supposedly knows the company the best doesn't believe in its future that much at these prices. And there's a bit of a also hype around Axon as well because they were added to Nasdaq 100 and all that. Same with Carvana, same with Palantir. So those are coming, but it's a very case by case basis. There's not like a formula that I look for. Like if it's above this P/E ratio, short it. Like it's not like algorithmic trading thing. Like there's no algorithmic trading that's going to catch MicroStrategy shorts. And a lot of people are going to look at that stock and be like, "Oh, this is very volatile. Don't short." Like for example, the guy who comes up here talking about how smart he is all the time, Machine, said, when I asked him which one of my shorts should I cover first, he said MicroStrategy at the top. You know, and his reasoning was it was very volatile, which is true. Like the risk is high and everything, but you can do a lot of things with risk. You can talk about you can look at how you short it. You can look at position sizing. You can look at your portfolio composition. So there's a lot of different things you can to limit that risk, but it all really comes down to valuation at the end of the day. And a strong understanding of intrinsic value, I think, is very important in investing, whether long or short.
Yeah, that's very helpful. So, so I'm guessing you're still holding the Axon Carvana short.
Yeah, yeah, I'm still haven't changed my view on those.
Okay, because Carvana went up today, and I wasn't sure if I should short it. So, do you have any advice for maybe advice is not the right word because again, you're going to say you're not going to offer financial advice, but
Hmm.
any thoughts on anyone who wants to short those now, like Axon and Carvana, and even
I mean,
Netflix actually?
the only thing I can tell you is that I still have those shorts, and I wouldn't
Okay.
have them if I didn't think the stocks are going to go down, obviously. So
Yeah, have you considered Netflix? It seems to be on the
yeah,
downward trend too.
I have, and I think the stock ran up quite a bit. Um, but the problem you have with Netflix is, I mean, the val. So I actually shorted Netflix a while ago, and I got my head handed to me, and I covered that short at a small loss before the stock surged. We're talking like a decade ago, and it's a very successful. And the lessons I learned from that actually, and that's a long story, but Netflix service has become really good over recent years, like way beyond what anyone really imagined 10 years ago. So management has executed really well. And imagine for a second that you have a recession. Okay. Now people are spending more time at home, and Netflix subscription is not really something that they're going to cancel, I don't think. Like they might cancel going out to a restaurant or a bar once or twice a month, but they'll hold on to their Netflix. And to the extent that they don't go out for entertainment, they're going to stay at home and consume Netflix. So there's a bit of an interesting kind of a hedge aspect to Netflix from a recession perspective. So a lot of my shorts are around recession. Now, on the other hand, Netflix valuation has run up quite a bit. So if I look at the since the bottom in mid 2000, Netflix stock went up by 5 times, more than 5 times. And so I'm not saying I would go long on it, but I also it's not really something I'm looking to shorting at this time. I mean, look at what happened to the stock during COVID. That's one of the best COVID stocks. When everything was plunging, Netflix stock was going up. It was up. It doubled. So in the first few months of COVID, and
Yeah,
yeah,
it had like that kind of massive run last quarter of 2024 as well. I had shorted it and I had made a major loss because I didn't know when to cut it, and then I just let the loss grow. Finally, I covered it, but after that, it started dipping. So I kind of like
yeah,
almost have a revenge attitude towards it, but because I got burnt once, I'm I'm hesitant to go after it now.
yeah.
And Tesla show.
And then also think about, like, in the longer term. Netflix's biggest expense today is content acquisition, but content creation is becoming cheaper at an extremely fast rate. And so, you can imagine one day Netflix having its own foundational model, or using one of these foundation models to create movies. Like, for example, uh, maybe Netflix algorithm continues to improve to the extent that I sit in front of TV and it knows exactly which actors I want to watch, which type of movie I want to watch that day on a weeknight versus a weekday, and just creates a movie for me at basically zero cost with those actors and the exact duration I want. But you can really personalize content if it's done in an automated way, and you're not relying on content creators. So I think Netflix is actually one of the best stocks that could really benefit from the declining content values, prices, costs, let's say. So I wouldn't short Netflix.
Oh, okay. Um, what about Tesla? Where do you see it going? To 350? Is that why you're still holding your short?
Yeah, Tesla is super overvalued today, and I think if there's a recession, if there's a recession, Tesla could drop to $100 per share for two reasons, for several reasons really. But one, um, it's capital goods. Like, I know it's not an older company and all that stuff people say, but it is definitely more of an older company than Netflix or any of the other Max 7 companies. Sometimes people say Tesla's an AI company and other Max 7 are not. Really? Like, if you look at Nvidia, Meta, all of those have Microsoft, they are more AI companies today than Tesla is. And maybe in 5, 10 years, when Tesla rolls out Robo-taxis and Optimus sales and everything, Tesla could be seen as an AI company, but that's not the case today. And it's not going to be the case next year either, or the year after. So, to the extent that there's a recession today or in the near future, Tesla will be priced, even if temporarily, on its free cash flow. Okay. And Tesla's free cash flow multiple today is several hundred times, somewhere between 300 to 400 times. All right. And the rest of the Max 7 is like 30, 40, 50 times. So Tesla is up to 10 times overvalued versus other Max 7, which are, cash machines basically. Tesla doesn't have that benefit. Tesla is not generating tremendous amount of cash. I was hoping that maybe the Cybertruck program kind of changes that in Q4, but that hasn't happened, right? And Cybertruck has come in way heavier than I thought. The range came in lower than I thought. The prices were higher than I thought, meaning the demand was restricted. And now Troy is telling me production cost per unit is even higher than the $80,000 price, which I really find hard to believe. But Troy is very accurate in his estimates, so I have to put some weight into what he's saying. So it doesn't appear to me that Tesla will turn the tide on low free cash flow anytime soon. Um, Q4 is a bit of a could be an anomaly because they delivered more than they produced, so there's a bit of a benefit to the cash flow there. But we're talking a bit more like medium term, like 1 to 3 years. So over the next coming quarters, especially in Q1, I think Q1 will be really challenging for Tesla for several reasons. One, because the seasonally weak quarter, Usually, automakers have higher production than deliveries in Q1. Two, like I said earlier, I think the demand fell off a cliff in the second half of December for capital goods producers and for big ticket items like cars and houses. And three, I think Cybertruck is having a bit of a problem here, demand wise. Interest rates are remaining high, and that obviously hits, you know, higher priced vehicles more. Like people can downgrade from Target to Walmart or Walmart to Dollar Tree, and they, just like that, they can downgrade from a Tesla vehicle to like a Toyota. So with higher interest rates because they can only afford only so much monthly payments. And then you also have student loan payments coming back for a growing portion of the population as well. We're talking tens of millions of students. So um, anyway, ACDC.
Yeah, Yaman. So if you look at recently, all the analysts and everybody, they've changed their tone, and now all of a sudden they're on the Robo-taxi bandwagon, right? And I agree. I'll give it some credence that Robo-taxi can add incremental value, but the way I see it is first you have to have the rollout, which means FSD being solved. Okay. Then you have to have the adoption. Okay. Which means, scaling and everything. And one of the things I'm surprised that I've never or yet to hear from any of these analysts is talk about the cash flow of Tesla as a company also while all this is happening. I mean, what about the capital outlay? Because all of these robo taxis will have to be produced, and these are not going to be sold, but yet held on the balance sheet. Okay, and they're going to hold on to this until the revenue from the robo taxi fleet starts trickling in. How do you account for that accounting measure? Like how do you think they're going to do it? How do you think it comes into the earnings?
Yeah. Man, I really need people to ask me questions in 10 words of fever. I don't have I check out when people talk like that. I'm
Okay,
sorry.
let me give you my chat GPT summary of it.
Thank you.
How do you think the capital outlay that Tesla will have to take look like once they take the robotaxi costs onto their own balance sheet?
Yeah, I mean, again, I don't think this. I think this is 5-10 years out. And if there is a robotaxi service started um, today, let's say hypothetically, each robotaxi would pay for itself in a few months. So I don't think the capital outlay problem is as big of a problem as people think. But if it's not, as my base case is, it's not going to be until 5-10 years from today, maybe later, nationwide. At that point, there's going to be other services. So now your margins are lower, your utilization rates are lower, and the number of units you're going to be able to utilize at a high rate is going to be lower. So now you have a problem, like the one you mentioned. But either way, it's not really on my radar right now. ACDC.
I agree, but I don't understand how you're saying that it'll pay for itself in a couple of months. I mean, even if you take $1 a mile net profit to Tesla, 200 miles a day, 30 days, that's $6,000, per robotaxi. And that's without taking any cost whatsoever in account and just a sheer net $1 profit.
Yeah. So you said 200 miles a day, which could be higher, right? But let's say 200 miles. So that's $200 a day. So I don't understand. So how is that not paying for itself in a few months? What am I missing?
Well, at just no cost itself, just the $1 itself would come up to be at least 4 or 5 months. I mean, what are we looking at the cost for the robotaxi? 20,000?
Yeah. Yeah. I mean, if you look at Toyota Corollas or Yaris production costs, like these small vehicles, Tesla Robotaxi is supposed to be like a two-seater, right? small vehicles, especially if you don't have the steering wheel and all that, you're kind of like cutting off a bunch of stuff. You can produce it for definitely less than $20,000, no question about it. Maybe even as low as 15,000, and you're making $1,000 a month in profit. So, but that's if you introduce today, which means you can make $1 a mile profit. But if it is delayed by 5-10 years and these other services ramp up, um, you know, hybrids and EVs are adopted by Uber drivers, then you're not going to be able to make $1 profit. Maybe you're making 50 cents per mile profit. So in that case, all of your calculation is kind of changes, obviously. So, I mean, is that your base case expectation that Tesla will have an internal robotaxi fleet sometime in the future?
I think that's their plan, that
Yeah.
they're going to have their own fleet, right?
Mhm.
Otherwise, what's the real gain to them if they're just selling the fleet and Uber's buying the fleet?
Yeah. Okay, then let me ask, before I go to Lucia, let me ask you, sorry, Lucia, just wait for a second. Let me ask you, when do you think Tesla will have 10,000 robotaxis in-house fleet?
I would say on a best case scenario, probably mid 26.
Yeah, I don't think it's going to happen.
Yeah, and that's a
I mean, if you
bullish
think that's
best
gonna,
case scenario.
if you think that's gonna happen, you should buy the stock, But yeah, if that's a bullish best case. But what about base case?
You know what? I'm going to present that as my base case. Okay, 2,500
Okay.
taxis in 4 different cities, or maybe 5,000 just California and Florida itself. Okay, but I just still don't think that adds any value to the bottom line. That's just that's peanuts.
But how can you have 4 different cities if you just started conversations in Austin, okay? And Waymo has been added for a decade, and they're only at a couple of cities, like 2-3 cities in volume, I think. I mean, really, majority of their revenue comes from one city, still Waymo, and the second city they're growing. And in Austin, they've been testing for a long time, and they haven't really scaled to the 2,500 robotaxi level in any of the cities, despite having been in San Francisco for several years. So how do you how is it a base case scenario? Luce?
I wanted to talk about two topics. So the first one is that the FSD tracker has changed the way the data is presented, and now there is not trimmed anymore. So the miles for critical interventions, it's like at 600, if I'm not mistaken. So I wanted to know your opinion about that. The second topic, it's the fact that I think Tesla might be impacted by a trade war with China, particularly referring to batteries. I think there is a good possibility that export on batteries might be heavily taxed, or they could be banned in the fact that China could not export batteries anymore.
I think Elias put a tweet on the changes. So let's go through. I haven't done that yet. So let me see this real quick. All right. So I just retweeted it, and I'm going to pin this up here, and then we can go through his updates. Pin it at the top of our screens, as well as showing it on YouTube. 2025 updates to the FSD community tracker, says Elias. Much like last time when I implemented a bunch of changes, I would like to describe all the improvements implemented for transparency. In May 2024, when I completed the last big update, I was primarily focused on preventing potential outliers from influencing the data. As a user pointed out in a recent reply from V10 to early V12 data, there was an overlap and only a minor difference in trimmed versus untrimmed data. However, that gap widened significantly in V13. I looked at the data in detail and identified that good performance data was being trimmed, which had a greater effect on the data than the lower performance. As an example, we have several users with 500, 600 miles with no critical disengagement that were being trimmed, along with several users who had 11 miles to critical disengagement with low mileage driven that were being trimmed. Even if this was 2 testers that would trim over 1,000 miles with no critical disengagement from the data, which is affecting the results. I keep a very close eye on the data and even added a few things on my end to help watch for malicious data. To date, there are no significant outliers that I have seen where someone's entering data maliciously. I decided to remove the trimming. Well, that explains it. This was a mistake on my part to account for an issue that didn't exist. That's something that comes with data analytics, and is that you have to constantly evolve your techniques and methods. That does mean I have to keep a much closer eye for outliers, but I'm already doing that anyway. Okay. So that explains, I guess, the increase in critical. I mean, the trimming was something that I recommend that he does back when this first started. And I think it's a mistake to remove it. So, but let's continue with what else he has to say here. Adjusted all charts and scorecard to use calculations that don't use trimming. Removed top N testers filter. It was duplicative of the distance filters underneath, and the ranks function was taking a performance hit to load charts. Replace it with an exclusion filter to filter out low mileage testers based on feedback from range, which is turned on by default. Added error bars to the top left chart and made it dynamic. So if you select hardware 3 or hardware 4, it loads the appropriate data and takes up less real estate. This was big change because previously I had hardware 3 and hardware 4 broken out separately and it was taking up too much space. The dashboard now provides a focus on hardware 4, but you can still easily see the hardware 3 data. Added additional filter on top 2 charts that requires 10 plus testers. This basically enforced the minimum amount of testers for sample size and comparison with other versions. Added border color on cards that if you filter for something that has sample size of 10 tests, it highlights the card border as red. Okay, that's good. And added no D indicator that appears if no D has occurred based on feedback. This may appear with early data on the list. 7. Added filter for model based on feedback from added breakout, etc. Yeah, I don't look at the statewide model breakout because just there's not enough data there. Yeah, I mean, remove the filter is a deal breaker for me. Remove all the trimming is a deal breaker for me. Okay. Okay, is there a question on FSD?
No, I can wait.
Okay,
It's
hold
not
on for
about
1 second. Luce, what do you think?
So, to be clear, you are in favor of this change or not?
No, this is ridiculous. I mean, the trimming is essential to the. But I like the fact that he had the error bars. But I'm gonna have to do some research on the tracker to better understand the impact here. But I already discarded using it for driving conditions. I think it's just way too granular for the level of data collection, and also statewide stuff as well. There's just not enough entries. So in my book, you need tens of thousands of miles, thousands of entries from hundreds of users to have any sort of reliability on the data. So that's why I only look at this on a major release basis. So V10 versus V11 versus V12 versus V13, which I see now that he removes V10 and V11 data, which is ridiculous. But it is what it is. He's the creator and he maintains the tracker. So it's up to him, obviously, at the end of the day. And, it is what it is. What's the saying? What's the saying from the Irishman? It's not. It is what it is. It's what it is. I think it's what it is. Lucia?
I personally am in favor of the change for the simple fact that you could basically trim the data 2 times. The first time he does it before including it in the displaying data. And the second time is that you can do it in the FSD tracker itself. So basically, I agree with this change. Another reason why I agree with it is
So
because
you agree with what change and why?
that the change of not trimming the data before putting it in the FSD tracker.
Why do you agree with not trimming it?
Because before he trimmed it, and then you in the FSD tracker, you could choose to trim it again, 5% or 10%. And in my opinion, it's better to not trim the data 2 times. And if you
I don't
want to
think you
trim,
would. I don't think you were trimming it 2 times.
but you could see the data trimmed 2 times, but because you could select 5 or 10. You remember?
Anyway, okay. And what's your next point?
The second is because it presents the data in the best possible, in the best possible perspective. Let's say that the best FSD can do is 500 miles for critical interventions, and I'm okay, taking for a fact the best possible scenario.
Okay. All right. Great. Well, you do you. Any other questions, Kay?
Yeah. What is your conviction on Tesla? Like, are you going to be holding that short until it gets to 100, or how long will you be holding the short? What will make you
Yeah,
change
I don't
your?
know. I don't know
You're a bit
if even if I
transparent.
knew, I would. Even if I
Okay.
knew, I wouldn't say it. And I have no idea who's in the public, who's in the audience.
Oh, I see.
Mhm.
So,
The only reason I'm announcing it is not because I want you to follow me, is not because of financial advice. I'm not telling people to short with me, etc. The only reason I'm doing it is because I'm the host of the space and people should be aware of any sort of bias. Okay. So people saw me as an Uber bull for years and years. When I short the space, had I not told them that I shorted the stock, then I don't think that would have been right. So that's why I told people, but and these are the kind of like idea generations. So I think let's say this stock, that's like Axon, this and that, I think is overvalued. You do your analysis, you see if it fits your goals and risk returns and everything you want to add to your portfolio. If you want to buy puts for the stock, doing it another way, you can choose, make those own choices. I'm not going to fucking do that for everybody. I would have to do it on an individual basis.
yeah, for someone new like me, who's new to your space, if you don't mind sharing, I only heard of you talk about Axon, Carvana, and Tesla.
Rivian
Probably
is
I
the other
missed
one.
your Rivian.
Yeah, I think Rivian is also
Oh, it's on your
overvalued.
short list.
I would put Rivian on the same list as Carvana and MicroStrategy maybe. Yeah, I think Rivian is going to zero, and so that's one I'm going to hold on for a while for probably.
So this
And
is
then
even this is
what?
regardless of their tie-up with Mercedes, right?
They're what with Mercedes?
Uh, unless I'm mistaken, didn't they have some sort
Volkswagen.
of? Oh, okay, sorry. Okay.
Yeah, that's regardless of that because that's just a cash. Rivian's problems are execution and fundamental. Like if, for example, the only way I would cover my short is if RJ left the company and they brought in Elon or something. At that point, I would probably cover my short. They have an execution problem.
Thoughts on Palantir? Are you holding that short,
I'm
or is it
short. Yeah, I'm short Palantir. I would put
okay?
Palantir in the same box as Axon.
Okay.
Fundamentally a good company. Like I think they're going to play a big role in the future, but they're temporarily overpriced, as well as Tesla. Let's put Tesla in that bucket as well. These are overvalued companies that I don't think we're going to go bankrupt or anything, but I think that they're just overvalued. And if you want to short something, you have to. It's hard to find short ideas. I think it's easier to find long ideas. Running a short profile is very difficult. It's not easy. Anyway, I see Elias in the audience. If he wants to come up and maybe talk about FSD tracker, we can talk about that for the final half hour of the space. Thank you, Kay,
Thanks,
for your
Robert.
questions.
Yeah, thank
ACDC while Elias comes up, if he can. Any questions, comments on your? Oh, there he is. Elias, welcome.
Hey, how you doing?
Good. So we just went through your changes. I would say the removal of the trimming is the biggest one. But let's say, what are the two other biggest ones you think that you made? So top
I
three
think
changes you made.
the kind of cleaning up or focusing on hardware 4. I previously broke it out and it kind of took up a lot of the charts and stuff like that. So now you can kind of toggle back and forth between hardware 3 and hardware 4. So just kind of cleaning it up and focusing on specific hardware so you can see the data and it doesn't get mixed in. And then I added a couple filtering. So like one of them, for example, by default filters off the testers that only report 50 miles. For example, somebody that only goes out for a couple drives and doesn't really give FSD a shot. But you can still untoggle that and see all the data. It's not like it's hiding it or anything like that. It's just a quick default to kind of focus on people that are actually reporting and testing data. Trying to remember off the top of my head. My head is like all over the place right now because I just went for like an hour driving the Cybertruck all over the place in the snow.
Okay. Why remove the trimming instead of making a toggle?
No, that's a good question. So when I initially set it up back in May, in my mind, I was like, well, let me just make sure that if we do get more testers, that it's not going to have a potential of being influenced by one or two people. And when I looked at the data, both trimmed and untrimmed back then, that was still like early 12.3 days. It didn't adjust it that much. Like it was pretty close to the same results. It was just slightly lower. However, as we've seen in 13, there is a huge improvement, a huge performance boost on V13. And the data between the two untrimmed and trimmed was growing further and further apart. And I looked at the data, I looked at the testers, I looked at kind of the averages across testers, the standard deviation. And it was just kind of obvious to me what was happening was if we had, and I'm just going to use a simple example of 10 testers, if we had testers number 2 through 9 all having, let's say, 300 miles to a critical disengagement. Maybe they haven't even had one yet. And then tester number 10 had 500 plus. And then tester number 1 had 2 miles to a critical disengagement because maybe they only tried it once, or maybe they just did 2 miles and they didn't have anything. So what was happening is you're trimming the number 1 and number 10, and then testers 2 through 9 were what the result was showing. And so to me, it didn't make sense to remove actual data that was valid because a lot of people are having a good experience. We see that. I really noticed it when we were looking at the percent of drives with no disengagement or no critical disengagement. It's the highest it's ever been. And we're seeing the best results we've ever seen. So it just didn't make sense why it was slightly better. Like I think it was 70% or something like that. Maybe it's 60, 70% when it should be, much higher than that. And we see it right now. It's like 100 and something percent. So, and then if you look at specific, somebody just kind of summarized a few of the performance improvements between V12 and 13 that I reposted, quote posted for them. But we're seeing at least, a few X improvement across the board. Highway is probably the biggest jump that we've seen. The miles to critical disengagement hasn't jumped significantly because we're still seeing some red light issues and some occasional obstacle avoidance issues. So there's still some critical issues that are there. So we're not seeing a huge performance jump. But when it comes to just general disengagements, we've seen a huge jump. The percent of drives that don't have disengagement, we've seen a huge jump. And the highway miles to disengagement is a huge jump. And me personally, like I've driven a couple hundred miles on the highway and I had yet to have a disengagement at all on the highway. It's nuts how good V13 is.
Okay. But you didn't answer my question. The question was, why remove it instead of making a toggle?
I probably shouldn't have put it in there in the first place. In hindsight, looking at the data and looking at what we see in the data, I shouldn't have put it in there in the first place.
Well, I disagree. I mean, that was my suggestion. The trimming was one of my biggest sticking points. When I switched from, I think this tracker is good but not useful, to good and useful enough. And now with the removal of the trimming, I just don't think it's useful at this point. I'm gonna have to do my own analysis from an individual tester perspective, I guess. And then I think the what you mentioned as the point you mentioned as support for removing it, which was the gap between trimmed results and untrimmed results growing, is a point for having the trimming, not removing it. That's why I want the trimming, because there's a gap. And
But that's
I think toggle would have been the better option to do. Give people give people the opportunity to see both, as opposed to. But this is your tracker. I respect your opinion. It's just I probably won't be using this tracker anymore.
that's fine. I think the biggest thing is looking at standard deviation. So when I looked at standard deviation, that's the deviation from the mean. And so when you look at the mean of the untrimmed data was there. And then the standard deviation off of that was significant compared to if I was trimming or not trimming. And so I think the biggest thing that you gave me feedback on that I liked was adding the confidence intervals to the main dashboard. So you can see that. So while it is untrimmed, you can still see the 95% confidence intervals in the data. So it's not like you can
I
just be like,
understand, but
oh yeah,
both are important. It's not like one or the other. Both are important for me. And then the other thing I don't understand is why remove hardware 3 data? Because part of the analysis is how will the performance improve from hardware 4 to hardware 5 to hardware 6, etc. And without having hardware 3 data in there, then it makes it harder to forecast hardware 5, hardware 6 data. So that's, I think, another mistake.
Yeah, it's not removed. So it's literally one tap. You'd hit the button that says HW3 on the screen and everything updates. So it's very simple. One tap to see hardware 3 and everything shows that data. So it's not
Okay,
hidden,
gotcha.
removed, or anything like that.
Okay, good. Good, thank you. I appreciate that. All right, I see, because I saw V10 and V11 gone too. But if I click hardware 3, then those show up. Okay, well, that's good then. That's good. All right. Well, the other thing I noticed from a bit, I was just informed that this change was made. I saw your tweet earlier, but I didn't get a chance to read it, and Lucha brought it up. So 12.3.6 data also went up to 459 miles per critical disengagement, right? How does that work?
Well, I'm looking at it right now. But again, it's the trimming versus not trimming. I could bring back the data so people can see it at least. Again, I'm not trying to hide everything. I'm trying to be transparent with what changes were made. And so I think the biggest thing is the jump. Again, I'd have to dig into it specifically. I do see what you're talking about. 12.3.6 was phenomenal. That was actually before V13. That was the best version I've had on FSD. So it kind of jives with it.
But we're talking on 12.5, not 12.3.6. The one that jumped is 12.5.
Now you said 12.3.6. So 12.3.6, I'm looking at it right now, has 459 miles to a critical disengagement overall, and 182 for city miles to a critical disengagement.
Oh, okay. Yeah, it really changes between hardware 3 and hardware 4. Can you add an option to do both hardware 3 and hardware 4? Like not one or the other, but also both? Like, so to the extent that some cars logged in data for the same software update with hardware 4 and also versus hardware 3, I want to be able to see both at the same time.
It was
And then
getting
I got you. And then the other thing is the error bars. What's the range you're using here?
Yeah, that's the 95% confidence interval. So you take the
Okay.
standard deviation and then you take the number of, testers and data inside of that pool. So let's just do a hypothetical here again of 10 testers. If there's 10 testers, you look at their miles to critical disengagement across the 10 testers, and then it takes the standard deviation across those 10 testers, and then the number of 10, which is the sample size, and then you do the 95% confidence interval off of that. So then it shows you kind of the range of what it would be based on the data that it has. So if you actually
Yeah.
hover over
So
points, it'll give you the upper and lower bounds for each point.
yeah. So as more data is entered, that range should ideal to shrink. But again, I really need both trimmed and the 95%. Like I love the error bars, but I definitely need, like it's a must have for me, the trim data.
Yeah, I think if you saw what I spent a few days looking and analyzing the data and looking at standard deviation. I think the biggest thing was that delta. Like I said, if you have a Tesla go 500, 600 miles to a critical disengagement, but then you have one dude that drove 2 miles or 10 miles, that's already a huge delta. So you can't treat those the same. And I think that was what my flaw was, is I was treating those the same, and they're not the same. Somebody driving more, like if I wanted to keep the trimming, for example, I would need to apply weighting or something that would allow the more miles to have a higher weight on the trimming instead of just doing percentiles, where I was doing top 10 and bottom 10. If you're going to do trimming, you have to do some sort of weight to where if you drive more miles, you have more drives, you drive more in the city, it applies almost like a score that would do weighting on top of the data. So that's something I am looking at, just FYI. I just felt that it wasn't really necessary to do it how I was doing, with the percentiles, but I think weighting would be the next mechanism. If I do make any adjustments to improve accuracy, that's going to be the other way of doing it, is weighting various factors in order to provide a more effective way of trimming. Because right now, just doing percentiles wasn't working.
We can talk about offline a little bit more, but the other thing I was gonna ask is there a way, like for example, Troy, when he presents, there's always links that you can go to raw data if you want to. Is there a way to post the raw data? Like this is the tester, this is the trip, like for each trip that's logged in. Is there a way to kind of have a tab that shows raw data, total raw data?
So the closest thing you're going to get to that is the tester view or the summary tables. I do not want to provide the raw data for various reasons, including privacy. But as far as like pulling what each tester is getting and their kind of data that's coming in, how many miles they're driving, how many critical disengagements they're running into, even what type of critical disengagements they're running into, the tester view tab is the way to get that data.
Yeah. Yeah, that's probably where I'm going to spend more data now, other than dashboard. I mean, I probably won't be using dashboard anymore, just because of trim. If the trimming comes, I'll use the dashboard. But thank you very much. I mean, still really appreciate all the work you're putting in, and I totally understand, um, you know, considerations outside of. Anyway,
I thought about it for a really long time. It wasn't something I just made off of a whim. And like I said, if I do apply trimming in the future, it'll be based on multiple factors and weighting.
yeah. See, I actually like the 10% higher, 10% lower, better, just because, like for me, the primary purpose of trimming is preventing manipulation. And if you don't do it on a percentage basis and you do it on a number of miles added basis, then it makes it easier, all else equal, for one or two people to manipulate data upside or downside. And I think the what you had earlier, which is 10% higher, 10% lower, and nobody knows which, like let's say there's 100, 100 people entering data, and 10% higher eliminated, that's 10 people. Now it's harder for a group of people to manipulate data one way or another. But if you do weighting and a couple of the people are driving 1,000 miles, most on the highway, then it's easier to manipulate the data. So the number of accounts, number of people that you need in a group of highly motivated in a group to manipulate, that's their purpose. That's going to make it easier. So that's why I need trimming to, but otherwise I'll do my own individual basis analysis, which is fine too, I guess, but it's just more time consuming. And most people won't do that kind of analysis. They'll just use a dashboard and they're going to look at the manipulated data.
Yeah, I'm going to keep an eye out more. I mean, I already do it, but I'm going to do it more frequently, more often, like multiple times a day throughout the day, looking for issues like that. So I definitely don't want anybody to take advantage of the changes that I've made. But I, like I said, I'm already playing around with and thinking about other ways of doing this.
Yeah. All right. Thanks, man. I really appreciate all the work you put in, and I know you're trying to do your best, and it's not really easy to satisfy everyone. So I totally get that. Ultimately, the decision's yours. All right. On that note, we're going to end the space. Thank you, Elias. Thank you, ACDC, and others who contributed today. I will chat with you all tomorrow. Take care.